Welcome to Finbot Insights. Today, we're going to examine a fascinating and, frankly, a devastating case study in financial self-destruction. Our goal here is to uncover one of the single biggest mistakes an amateur investor can possibly make.
Let's begin with the final result, just to understand the scale of what we're talking about. This number, -97%, represents a near total portfolio loss. And what's truly shocking is that it all happened in just 2 months.
Now, here is the central mystery. This catastrophic loss occurred while the underlying markets were almost completely flat. Over that very same 60-day period, the S&P 500 lost less than 1%, and even Bitcoin, known for its volatility, only fell by about 4%.
This really raises a critical question, doesn't it? How can an investor lose virtually everything when the market itself barely moved? So let's investigate this financial crime scene together and find out what really happened.
The evidence for our case comes directly from the brokerage statements of an investor, who we're going to call Fernando. In a very short span of time, he had managed to turn an account with nearly $100,000 into a mere $3,000.
The data was startling. It showed that almost every single asset he decided to buy seemed to rapidly depreciate almost immediately. It's a phenomena I sometimes call the reverse Midas touch. Because the broader markets hadn't crashed, we can't blame external factors. They just weren't the primary culprit here. The initial analysis really only pointed to one single unavoidable conclusion. The investor had no one to blame but himself.
So, to really get to the truth, we need to methodically rule out the obvious suspects. We're going to do that by analyzing both the market conditions and Fernando's specific actions during this 60-day period.
Now, at first glance, if you just look at the start and end dates, the environment seems quite stable. Both the S&P 500 and Bitcoin saw only very modest decreases. This fact, of course, only deepens the mystery of his 97% loss. But you see, looking only at the start and end dates can be incredibly misleading. A closer look at the daily volatility reveals some pretty significant price swings. The S&P 500 saw a variance of 9% between its high and low points, while Bitcoin experienced a much larger variance of 21%. This hidden volatility presented both a huge opportunity and a very serious danger. And when we looked at his account statements, the true mechanism of the loss became crystal clear. Fernando wasn't the victim of some market crash. He was the victim of his own repeated behavioral error. He was consistently buying high and selling low, over and over again, until his capital was almost entirely gone. Looking at a timeline of his trading activity, you can see a very predictable path to ruin. A little bit of early success in week 1 bred some dangerous overconfidence. Then, as the first losses appeared, his trading frequency and his bet sizes increased dramatically. By week 3, desperation took hold, and by week 6, the account was completely decimated. You know, the core of Fernando's failure, what it all boils down to, was a complete misunderstanding of the fundamental difference between two very distinct market activities.
What he was doing was pure speculation. This is the act of trying to time the market, making moves based on short-term predictions, raw emotion, and social media hype. It is, in effect, just a form of gambling on price movements. True investing, by contrast, is something else entirely. It involves owning an asset based on its long-term, fundamental value, while consciously ignoring all of that short-term noise. It's a disciplined, patient approach that's based on an asset's intrinsic worth.
So now that we've diagnosed the problem as rampant speculation, we can construct the proper solution. And let's use Bitcoin, the very same asset that contributed to his downfall, as our primary example. A sound investment approach for a volatile asset like Bitcoin is not to trade it, but simply to hold it. The philosophy is incredibly simple. 1. You buy the asset. 2. You hold it through all the price swings. 3. You ignore the daily noise. And 4. You commit to a truly long-term time frame, a minimum of 5 years, though 7 to 10 is even better. Now, why is this strategy so effective? It's because long-term value is driven by fundamentals, not by the random, unpredictable events that create all that short-term volatility. Short-term price is affected by noise, things like celebrity tweets or regulatory news. Long-term value, however, is influenced by fundamentals like scarcity, its utility in solving a problem, and its rate of user adoption. And this is a crucial point. Even with a sound strategy, prudent portfolio construction is paramount. Volatile assets like cryptocurrency should always represent a very small portion of a total portfolio. A common guideline is to allocate no more than 5% to this particular asset class. This simple, disciplined approach is so powerful because it allows you to completely sidestep the financial industry's most profitable and most powerful illusion. You see, the industry's greatest trick is using the power of misdirection to make investing seem impenetrably complex, and this perceived complexity serves a very specific purpose. It's designed to convince investors that they need to pay hefty fees for so-called expert management, when in reality, the most effective investment strategies are often the easiest to learn and the simplest to implement. It's simplicity and discipline that consistently lead to success over the long run.
Ultimately, Fernando's story challenges all of us to examine our own approach. It leaves every single one of us with a really critical question to answer for ourselves. Are you building wealth, or are you just gambling?
Thank you for watching this Finbot Insights Explainer. If you found this analysis valuable, please do click the like button and subscribe to the channel for more data-driven financial insights.